Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video, we're talking about a number of specific stocks. These are all stocks which have been featured on the channel before, but which we haven't discussed for a little while, and which don't really warrant an update video in their own right. We're going to be talking about Atlassian, Rimini Street, Lcyc, Stem, and Akerna. So if you're interested in any of those stocks, then this is definitely one you don't want to miss. This is also something which a number of you have asked for, so here you go. So this week on the channel we're also going to discuss some new stocks which are currently on my watch list, some dynamics which are at play in the market which investors need to understand if they want to generate consistent, strong returns, and also addressing some of our existing investments. Before we get into it, please smash the like button. We don't do clickbait or clickbaity content on the channel here, and so when you hit the like button, it's really helpful for the channel and it encourages the YouTube algorithm to share the video with a wider audience. If you're new to the channel, then make sure you're subscribed. If you want to see more exclusive content like our patron-only video series about how you can learn what the professional investors are doing and apply that to your own investing to become a better investor, as well as the private Discord group and a load of other things, then check out the Patreon page. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So first, let's talk about Atlassian. We first covered them on the channel in around June 2020, when the stock price was about $185. And I shared my thesis on why I was bullish in the coming months for them and why I had personally invested in the company. The stock has performed really well since then, growing by around 130% to its current price of around $395. On an annualised basis, that's a solid return of around 98%. Now, I established a decent position in Atlassian, and the company has performed well over this period of time. However, personally, I believe that now is a sensible time to crystallise some of that gain and realise some proceeds. Now, I'm not saying this is the end of the road for Atlassian, not at all, and I will retain some of my stake in the company. However, there is a really important takeaway and reminder for all investors here. It's really important to recognise some of those gains made from investing. It's very easy, especially when you're new to investing, to get emotionally attached in invested stocks and not turn those paper returns into cash returns. At the end of the day, it's a business and you need to divorce that emotional side from any decision making. Now, another important consideration here before we return to Atlassian specifically is around position sizing. Now, on this channel we talk about a bunch of different stock types, from large blue chip established tech stocks, which Atlassian sits under, all the way through to riskier penny stocks and growth stocks. Clearly, when I say I've made an investment into a stock, that does not mean that each investment I make is of the same quantum. I factor this risk into my decision making and my portfolio management, so the positions that I take in riskier stocks are typically smaller investments than those which I make into less risky, more established blue chip stocks. Atlassian being a good example of that less risky end of the spectrum. Now, this all forms part of any normal practice portfolio management approach which all investors should ensure they practice with their portfolios. The more established, less risky investments should be your larger positions, whilst the smaller, more risky, perhaps speculative plays should be the smaller positions you take. Now, we do cover this in a load of detail on the Patreon channel, so if you want to understand more about this, then definitely check that out. Anyway, back to Atlassian. Now, I discussed in the Discord group over the last week that I have started exiting some of my position in Atlassian. Now again, I'm not saying that Atlassian won't grow from here. In fact, I'm sure it will, and that's actually part of the reason why I'm maintaining some of my investment, just a small portion of that, still invested in Atlassian. However, I'm happy with the return that I've generated to date, and to now turn some of those paper proceeds into cash proceeds, which I will then be allocating towards a few other positions, which we will discuss over the course of the coming weeks on this channel. As well as that, I will be holding a larger portion of cash than I currently have in my portfolio as well. Of course, I will continue to keep an eye on Atlassian, and any meaningful updates, of course, I'll share on this channel. If any of you also invested in Atlassian at the same time, or hold Atlassian in your portfolio, I'd love to hear what your thoughts are around your potential exit strategy. Anyway, on to the next one. The next one to talk about is Rimini Street. Now, this one we discussed on the Patreon group where I shared some analysis at around the end of February 2021. Then in March 2021 I uploaded a video on YouTube covering them. Now, since initiating that position, this is up around 40%, or on an annualised basis around 75%. As discussed in the Discord group and on a post on Patreon, I've started decreasing my position here slightly too, but will again retain a degree of exposure. I won't go into all the specifics here, but good news continues to flow from the company, and they clearly still have a very strong value proposition. However, there is still that legal situation with Oracle hanging over the company. Now, next up, let's talk about Lcyc. Now, we first covered this stock on the channel when it was still a SPAC, and since then the SPAC merger has completed, and it's now trading on its own ticker. Now this is really the definition of a long-term investment here, and one where looking at the stock price daily or even weekly or even potentially monthly is madness. As a reminder, when we invested in Lcyc, we knew that it would not be until 2023 that the operational infrastructure of the business would be completed and that it would actually be able to even start executing on its business plan. Specifically what we're talking about here is that hub facility for recycling the batteries and for the various spoke facilities to support that. From the updates out of the company that we've had to date and recently, it's on track with its construction plans. It has contracts in place to provide the volumes to process and deliver the financials which have been outlined in the plan, and everything's on track. As well as this, there's also been positive coverage from the stock from analysts, with buy ratings and good price targets much higher than the current stock price. These also aren't from Mickey Mouse analysts either. UBS is one of the analysts with such a buy rating on the stock, and so that's always a good thing to see when it's an established bulge bracket bank like that. In my opinion, anyone selling the stock now clearly did not know what they were investing into, or alternatively has taken a highly speculative gamble on the stock exploding in value, perhaps underpinned by the previous dynamics in the SPAC market where anything EV related had a massive bump, whether that made sense or not. With Lcyc, be patient and let this play out. Nothing company specific has occurred which may be driving this dynamic. In addition to this, the macro landscape for the offering and proposition offered by Lcyc continues to grow, and this is great news and investors should be positive about this, as ultimately that's just good news for the stock. Recent developments in the UK and across some of Europe will also accelerate the energy transition to green energy and battery storage required as part of this, as well as accelerating the adoption of electric vehicles. All of this ultimately means more batteries. More batteries ultimately means more demand for these to eventually be recycled, and all of this is good news for Lcyc. This is a thesis-led investment. If you believe in the electrification of transport and a transition to green and renewable energies, then you believe in the growth of batteries and therefore the need for those to be recycled, which is exactly what Lcyc plays at. Be patient, know what you've invested in, and remember this is thesis-led investing and it never is a straight linear clear journey. Whilst we're on the topic of batteries, we should also quickly update on STEM, which we have been covering on the channel for approaching a year now, when that was previously a SPAC trading as Starpeak Energy Transition Corp. STEM is another thesis-led investment and it continues to perform well. One thing to remember about STEM is that the purchase of its products by its customers represents a large capital outlay, and so the sales cycle is slower than many other tech companies may experience, for example. That being said though, STEM is performing well and is outperforming its plan still. In its most recent quarterly results, STEM announced revenue growth for Q3 21 of 3.5 times those reported in the same quarter for 2020. It also reported growth in the pipeline and the contracted backlog. This should provide investors with a strong degree of confidence that STEM will perform its full year financial forecasts. What's more, STEM is continually getting much more and more recognition from the investor community at investor presentations and investor conferences. And this is also reflected in the growing percentage of institutional investor ownership in the stock. Now, in addition to all of this, STEM also announced recently that it had won its first international customer in Chile, and this is just one of the first parts of the growing internationalization of the business, as ultimately green energy remains a key priority on the global political agenda. Again, this is a long-term investment, there's still massive potential here, but investors need to be patient. This is a slow and steady scaling business, underpinned by massive macro tailwinds. The business isn't going to quadruple in size overnight, but investors who understand what they've invested in would always have understood this dynamic. Now the next stock which we need to talk about is Akerna. We first discussed Akerna on the channel about 8 months ago. In this scenario, the stock performance has actually been slightly disappointing. However, there are a number of factors here which investors need to be aware of and are really important to keep in mind. Since we last discussed Akerna on the channel, the company's delivered an impressive set of results and also completed a sensible acquisition. Software sales, that's the recurring revenue line within the business, has grown to $4.5 million, or on an annualized basis around $18 million. As well as this impressive growth, there are no signs of churn increasing or being at unusual levels within the business, which actually would be a real potential red flag here. So again, that's good to see. Now I say this specifically in light of increased competition in the cannabis sector and the potential impact that has on Akerna's customers. If we had seen increasing churn, it could have perhaps been indicative of its customers going bankrupt, but that's not the case so far, so that's good to see. Additionally, it validates our initial hypothesis around the mission criticality of the software. its customers can't be without it, so it's one of the last expenses and last things they look at to try and save costs. In the same earnings report, it reported strong growth in consulting revenues, which were up 4 times on the same quarter in 2020. The margins were also moving in the right direction, and all of this is good news from a solely financial perspective for the company. The company also recently completed a sensible strategic acquisition, which strengthens its propositions to SMEs within the sector. The target company has a solid financial profile, and there is likely a great potential for recognition of a lot of synergies here, so again, this is good news for investors. All of this aside though, the stock price has been quite disappointing. But the important thing for investors to remember here is that this is not a function of company-specific dynamics. We will come on to why this is the case in a moment. The important thing to remember here is that the need for customers to use the product still exists and continues to grow as the illicit cannabis market is cannibalized by the legal market. If you believe in the continuation and growth of the legal cannabis market, then you should still be confident in the stock and the belief that the services which Akerna provides remain mission critical and essential to operators in the space. Be patient. I have said this a couple of times in this video, but again, this is a thesis-led investment, and you can never expect the journey from position initiation to exit to be a linear one. Know what you've invested in and have conviction in that investment decision. In this stock specifically, we're here early, so we need to be more patient than we may have to be in other stocks where we're not quite as early to the party. Ultimately, Akerna's offering is required by regulation. It's not a nice to have, it's a must have. Remember that as the sector grows, that demand will grow and eventually that will be reflected in the stock price. Akerna probably has been a victim somewhat of a shift in sentiment away from the cannabis sector. Now I will cover this whole concept in a separate video because it is really important, but remember that sentiment is not permanent and it will change. Just because sentiment has worsened towards the cannabis sector over the course of this year and since we initiated our position, it does not mean that this is permanent. A change, say a regulatory development, could very quickly indeed shift this sentiment in favour of a more positive one. Just remember that Akerna is performing well and it's not a company specific reason. Anyway, that's it for this video. I hope you enjoyed it. If you did, please smash the like button. Subscribe to the channel if you aren't already and check out the Patreon for more investing related content. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching and I'll see you in another video.